So 4,500 is what you're targeting right now. I mean, given the fact that we do have higher rates and higher rates for longer, wherever that final terminal rate shakes out, where the Fed is concerned, I mean, this environment looks very different than the past decade plus. Is the past decade plus an outlier, and this is a return to normal, or is this an outlier? And how do you think about it as you are constructing a portfolio?
So as we think about the last decade, what really was driving the economy was higher growth. You had lower rates, you had low inflation, you had rising profit margins. And all of those things led to a recipe that allowed for the markets to rise. And if you were invested in equities, particularly U.S. equities, you would have outperformed the rest of the world. If you were focused on growth equity versus value, you would have outperformed. If you were focused on technology stocks over financials, for example, you would have outperformed. So in this market in the last 10 plus years, equities really led the way, particularly U.S. equities. Now, moving forward in the next 10 years, it certainly looks different because right now we're in an environment of lower GDP growth, higher inflation, higher interest rates, lower profit margins. So from here, we really think that investors need to rethink their portfolio construction. And instead of focusing just on beta, it's all about alpha now, because the cost of capital has gone higher and investors are no longer just paying for revenue. They want to look for profitability. So there is an element of security selection that needs to be in this type of market in the next cycle.
So what are some examples of that?
So some examples, I would say, if you take a look at your portfolio, you should diversify in terms of equities. Within equities, you can take a look and be a little more nimble, go global, right? Because it's not just opportunities here in the U.S. You can look overseas in Europe, in Asia, in the emerging markets. You can also look out within fixed income. There's a lot more yield than there was just a couple of years ago, right? So there's cross-asset competition now. Fixed income has really come to the forefront, and you can think about municipal bonds from a tax-aware perspective. You can start thinking about lengthening duration. And then, of course, in further diversification of your portfolio, you can certainly look to private assets. So whether it's alternatives in terms of hedge funds or private equity, private credit, private real estate, all of those things could be ingredients into your new portfolio. So a key question I always get is the 60-40 dead? And from my stance, I don't think the 60-40 is dead. I do think there's room for improvement, though.
Okay, so 60-40 isn't dead. There's room for improvement. I guess, is it a different breakdown then? Is it like 70-30? Or is it really just, you know, depends on risk appetite of clients?
I think you can take your portfolio and if we realize that equity markets are no longer returning, let's say, annualized year-over-year returns over the 10-year period in the previous period of about 13.8%, moving forward, we think those returns look a little bit more mid-single digits, around 6%. So from that regard, equity returns will still be attractive versus other asset classes, but you need to be very focused on what you're investing in. So now's the time to be very idiosyncratic. Now's the time to further diversify within your portfolio. Perhaps now it's time to focus more on income, locking in some of those returns prior to year end to allow you to generate the level of return you need to make up for the difference.